When you really look at a modern economy, you kind of have to wonder, what actually keeps those massive gears turning? Think of it like a giant, wildly complex engine. But every engine needs fuel, right? Well, in this case, the fuel is savings. Welcome to this explainer. Today, we're going to unpack the inner workings of the Indian financial system. We'll see exactly how idle cash is transformed into the driving force behind trade, commerce, and ultimately, national growth.
Okay, let's dive into this. Here is our roadmap for today. First, we'll look at the financial system engine. Then we'll meet the folks regulating the markets. After that, we'll compare money versus capital markets, zoom into specific money market instruments, and wrap it all up with a real-world T-bill scenario to see exactly how this works in practice. Section 1. The financial system engine. Right, let's start with the big picture. Literally, every economy faces this fundamental problem of capital allocation. Some people have surplus cash sitting around, while others desperately need that cash to build and produce. The intricate solution to this massive puzzle? It's the financial market itself.
So the crucial point here is that a financial system isn't just about your local bank branch. It's an entire web of institutional arrangements. Think of it as a massive pump. Its core job is to mobilize financial surpluses, mostly taking surplus income from households saving for the future and transferring it directly to those who need it, like the trade, commerce, and manufacturing sectors. And it covers the whole shebang, from complex credit agreements all the way down to everyday cash transactions.
But what does this system actually do on a random Tuesday? Well, it regulates the currency, performs essential banking functions, safely holds custody of cash reserves, controls credit, and, maybe most importantly, maintains liquidity in the market. Now, for this entire machine to keep growing long-term, it can't just sit there. It actively relies on continuous investor education, it needs financial institutions to have the autonomy to be highly efficient, and it has to minimize market segmentation so those funds can flow freely.
Section 2. Regulating the markets. Of course, an engine pumping this much high-octane fuel absolutely needs strict safety protocols. Otherwise, it blows up. And that brings us to the traffic cops of our financial highway.
Okay, I know this might sound like alphabet soup, but the safety of the Indian market actually relies on four main pillars. The SEBI Act of 1992 is the heavy hitter here. It sets up the Securities and Exchange Board of India as an autonomous body to protect investors and crack down on intermediaries who break the rules. Then you've got the SCRA from 1956, which basically prevents shady transactions by keeping a tight leash on stock exchanges. The Depositories Act of 1996 literally revolutionized things by dematerializing securities, meaning they now exist in electronic book entry form for maximum speed and safety. And finally, the Companies Act of 2013 ensures companies make standard disclosures when they issue and allot shares.
And look, these regulations aren't just dusty, abstract laws. They actively enforce the standard disclosures and safe, fully automated screen-based trading systems that investors rely on every single day. Plus, India is aligned with international organizations like IOSCO, whose members regulate over 95% of the world's securities markets. That ensures our domestic protections actually meet really rigorous global standards. So with those safety checks firmly in place, let's look at where the actual trading happens.
Section 3. Money versus capital markets. We're zooming in now from the overall system to the two major distinct lanes of the financial highway. Understanding the difference between these two is absolutely critical for anyone diving into finance. Now, what's really interesting about this is how we can contrast these two directly. The money market, that is the fast lane. It deals strictly with short-term finance of 1 year or less. You're trading instruments like T-bills and commercial paper to fulfill immediate business credit needs. Because it's so short-term, you're looking at lower risk and very high liquidity. On the flip side, the capital market is for the long haul. This is where you find your stocks and bonds, meant to fund long-term fixed capital, like buying land or a new factory. It carries higher risk and lower liquidity, for sure. But the stock exchange within this market acts as the ultimate barometer for the overall economy.
Section 4. Money market instruments. All right, let's take a sharp turn right now into that fast lane. We're going to look closely at the specific tools used by the Reserve Bank of India, commercial banks, and large corporations to manage their daily, short-term liquidity. First up, the gold standard of short-term instruments, Treasury Bills, or T-bills. These are zero default risk, sovereign papers issued by the RBI on behalf of the government of India. Notice how they come in incredibly precise tenures, 14, 91, 182, and 364 days. You can grab them in multiples of just 25,000 rupees. What's super fascinating is how they're sold. They often use a French auction where you pay what you bid, or a Dutch auction where everyone pays a uniform cutoff price. Basically, you buy them at a discount. The government pays you back at full face value, and that difference, that's your profit.
Next is commercial paper, which was introduced in India back in 1990. This is an unsecured instrument, which means it's backed purely by the reputation of the issuer. Because of that, only highly rated large banks and corporates can issue it. Specifically, the issuer needs to have a tangible net worth of at least 4 crore rupees, and their borrower account has to be classified as a standard asset. The setup allows major companies to borrow directly from the market at interest rates that are usually way lower than what a traditional bank would charge them.
Moving along, we have certificates of deposit, or CDs. These are negotiable, dematerialized instruments. Banks can issue them for anywhere from 15 days up to a year, while financial institutions can stretch that from 1 to 3 years. The minimum investment here is 1 lakh rupees. They are incredibly flexible because there is absolutely no lock-in period, which makes them highly transferable. The only catch is that the issuing bank cannot grant loans against their own CDs or buy them back before maturity.
Let's move to and see how this builds into something a bit more specialized. Intercorporate deposits, or ICDs. Think of this as the corporate equivalent of asking your neighbor to borrow a cup of sugar, except the sugar is millions of rupees. Because this market lacks strict organization and carries literally no security, the risk is significantly higher. But as we know in finance, higher risk demands a higher reward. So ICDs naturally offer some of the highest interest rates you'll find in the short-term market.
Section 5, a real-world T-bill scenario. Okay, we've got the definitions down, but to truly understand the power of the money market, we need to see it in action. Let's look at exactly how these abstract instruments solve very real, multi-million-dollar corporate problems.
Imagine a company. Let's just call them Party A. Today they are sitting on a massive cash surplus of 200 crore rupees that's earmarked for a huge new project. But here's the thing, they don't need all that cash today. Look at their timeline. They need 50 crore in exactly 14 days, 20 crore in 91 days, 30 crore in 182 days, and the final 100 crore not until 364 days from now. They need to deploy this idle cash efficiently, and they need to do it right now.
And this brilliantly illustrates the sheer power of money market instruments. Let's compare their options. Option I is standard bank deposits. Because those deposits often require a minimum time frame, Party A actually can't lock up the 70 crore they need within the first few weeks. They can only invest 130 crore. Assuming a 6% return, they earn roughly 76 lakhs. Now look at option 2. Because T-bills come in those exact 14, 91, 182, and 364-day maturities we just talked about, Party A can invest the entire 200 crore today, perfectly matching their future cash needs. Assuming an 8 to 9% return, they earn approximately 125 lakhs. By utilizing the money market, they literally just made nearly 50 lakhs more on the exact same pool of idle cash.
Now to actually prove the math behind those returns, let's look at one final calculation, yield to maturity, or YTM. Remember, T-bills are discounted. Let's say a cooperative bank buys a 91-day T-bill, but they buy it in the secondary market when there are only 55 days left until it matures. They pay a discounted price of 99.1489 rupees for every 100 rupees of face value. If you take that discount, which is roughly 85 paise, multiply it by the 365 days in a year, and then divide that by the purchase price multiplied by the 55 days remaining, you get exactly 5.70%. The math is the real hero here, proving exactly how the discount rate gives you a precise annualized return.
It really all comes full circle. The financial system relies entirely on savings to fuel the economic engine, but it requires smart, incredibly precise instruments to allocate that fuel exactly when and where it's needed without stalling the machine. So I want to leave you with a thought to ponder. If short-term savings fuel the immediate engine of trade, how efficiently is your organization deploying its idle cash today? Are you using the fast lane, or are you leaving potential returns sitting idle on the shoulder? Thank you so much for joining me on this explainer. Keep learning, and I'll see you next time.